Okay, so it's 2:35 p.m. So with 5 minutes delay, welcome to the fourth session based on contributed papers of this nice conference. Although I'm part of the scientific committee, I'm very thankful to the real leaders of the event, Ángel Estrada and Rafa Repullo, for making this possible, also in the nice hybrid format that is being experienced, I think, with very minor technical problems. It's also a pleasure to share the session today with José Berrospide from Federal Reserve Board, David Elliott, Bank of England, and Juan Londono, also from Federal Reserve Board. And three academics. So it's a session with three economists of policymaking institutions and three academics as discussants. Three academics which are very close to me, but this was, I must say, not my choice. So I'm sharing the session in terms of academics with my current colleagues at the Advisory Scientific Committee of the ESRB, Loriana, Pelizzon for the first paper, Giovanna, Nicodano for the second, and as a third discussion in the session, my good friend and co-author, Oren Sussman. So let me take this encompassing presentation and without further delay, get into the first paper, which is on macrofinancial feedback, bank stress testing, and capital surcharges. We will respect the standard 20 minutes, 10 minutes, 10 minutes allocation.
Thank you, Javier. Good afternoon, and thank you to the organizers for the opportunity to present this paper, which is co-authored, a joint work with Tobias Adrian and Romain Lafarguette, both at the IMF. So the usual disclaimer applies. What we're going to say here represents only our views and not those of the Fed or the IMF. Let me start saying that this is the third time we're presenting this paper, so this is still work in progress. And I'm looking forward to all the comments and feedback that you might give us. All right, so what do we do in this paper? So we're going to propose a framework to assess vulnerabilities across the financial and the business cycle. And we're going to use the framework to calibrate a capital surcharge using or in the context of bank stress tests. For that purpose, we're going to develop a very parsimonious and reduced form model that is going to study the interactions among three main variables: GDP growth, an index of financial conditions, and bank capital. And we're going to use this reduced form model to measure feedback effects, which we're going to call the macrofinancial feedback. And these are essentially the way banks amplify exogenous shocks to the economy. And then we're going to use the framework again to calibrate a capital surcharge, which is the additional capital that you would think the banks would need to operate with in order to offset the macrofinancial feedback. As you're going to see, we're going to link the calibration of the capital surcharge to the idea of a countercyclical capital buffer. And we're going to do it in the context of the growth at risk framework as our measure of systemic vulnerabilities. So let me start talking about in detail what we do in our empirical work. So to start with the data, we're going to use quarterly data for the US from 2000 through 2019. And the simple reduced form model is going to use contemporaneous and lag interactions, as I said, of GDP growth, changes in bank capital, and an index of financial conditions. Interestingly, we're going to construct the index of financial conditions using information from the severely adverse scenario in the CCAR stress test exercise in the US. We're going to use the 2020 exercise. So you can think of, we're going to use the shocks included in the severely adverse scenario to estimate the model and to compute the feedback effects. The financial conditions index is shown here in this figure in the dashed red line. And as you can see, we observe a very strong negative correlation between financial conditions and GDP growth, which we're going to exploit in our framework. The model has several, I would say, interesting, unique features. One is we're using this in the context of the CCAR stress testing for the US banks. The second one is that we measure bank capital in the same way as we traditionally do it in the stress testing exercises. We're gonna use the change in capital to avoid certain non-stationary properties of the capital ratios. As you can see, the capital ratio in this figure is shown again in red, and you clearly see an upward trend after the global financial crisis, and as a result of the global the financial reform, the implementation of Basel III. Instead of the capital ratio, we're going to use the change in capital, and the way we're going to approximate the change in capital is through this concept of pre-tax net income, which in the context again of the stress testing exercise, this measure of the difference between pre-provision net revenues, or PPNR, and net losses. This concept is going to exclude taxes and assumptions about capital distributions, which you may also think might be endogenous. So, as you clearly see, the change in capital measured again by the PTNI as a percent of risk-weighted assets it's much more well-behaved, exhibits non-stationary properties, and actually follows very closely measures of profitability of the US banks, such as the return on assets. So here's a representation of our model, and one of the other features that we're going to use is we're going to use quantile regressions because we want to understand what's going on at the tails of the distributions of our variables. So we're going to incorporate contemporaneous and lag relationships among these variables in order to estimate. We're going to use some assumptions, like, for example, triangular ordering. So we have a recursive estimation. The first equation is the equation of GDP growth, and the recursive ordering, if you want, the triangular ordering is going to be supported by some granular causality tests that we include in the paper. And we find that GDP growth is the most exogenous variable, and it's going to depend only on lagged values of the other variables. The second equation describes the evolution of the change in capital, again, PTNI over risk-weighted assets. And that variable is going to depend on contemporaneous values of GDP and lag values of the other variables. And the third one is the index of financial conditions, which is the most endogenous variable in the system and depends on contemporaneous values of both GDP growth and the change in capital and the lag values of the other variables. In this three-variable system, actually, we're going to use also an auxiliary equation if you want to keep track of the evolution of capital, which is more like a deterministic log of motion to represent the evolution of the capital ratio, the level, if you want, of the capital ratio. And we're going to, as I said, we're going to estimate the system using quantile regressions, and we're going to do a dynamic simulation using the quantile sampling approach in Schmidt and Xu. So you can think of, we're going to forecast more than the typical impulse-response functions. We want to estimate the entire distribution of the variable, the conditional distribution of the variables in the system. Given that we are incorporating both contemporaneous relationships on the right-hand side of the system, you can think of we're going to face some endogeneity concerns due to simultaneity determination of the variables. And we're going to address this endogeneity problem in both of the financial conditions index equation and the change in capital equation using the instrumental variable, granular instrumental variable approach of Gabois and Cogent 2020. And as you can see in these two equations, I'm just highlighting in red the endogenous variables. And we're going to instrument, again, using this method of Gabois and Cogent, we're going to instrument the change in capital and the level of capital using the granular information that we have for about 20 plus banks that participate in the stress testing exercise in the US. We're going to use the granular PTNI over risk-weighted assets and the granular Tier 1 over risk-weighted assets. And for the financial conditions index, we're going to instrument that with granular information on the bank's probabilities of default or expected default frequency. And we're going to use also a proxy for the cost of issuing capital or funding costs for the banks using a CAPM cost approach. With that in mind, let me give you a little bit of details about what we do in this granular instrument variable approach. So we want to get sort of like truly orthogonal residuals or shocks in the system. So for that purpose, we're going to use the instruments, and we're going to run a panel regression with both time and fixed effects. In other words, we're going to exclude the heterogeneity over time and across the banks. We're going to capture the residuals, and then we're going to do some principal component of those residuals. In other words, we're going to sort of like use a weighted average of the largest idiosyncratic shocks in the system, in which, of course, the largest banks are going to have a higher weight. And then we're going to use the standard instrumental variable two-stage procedure with the instruments in the quantile regressions for both capital and the financial conditions index. So you can think of in this three equation system that the direct effect of the shocks in the economy, say in GDP growth, and the shocks to the financial conditions affecting bank capital as the typical exercise in the stress tests, right? No feedback effect. Considering that we have all the dynamics in the system, we can also estimate the impact from the shock bank capital back into the economy, both on GDP growth and the financial conditions index. And this we're going to call, as I mentioned before, the macrofinancial feedback. And as I said, this represents how the banks will amplify the external shock to the economy. So the macrofinancial feedback actually is, you can think of is being calculated as the difference in the projected path of GDP, right, in the fully fleshed model, in the unrestricted model, minus the path of GDP growth in the restricted model, in which we shut down the responses of bank capital to both GDP growth and financial conditions. And this is what I mean by a restricted model in which we shut down the responses of bank capital to both in the first equation, if you want, and the third equation, right? So we're going to proxy for the level of capital at the beginning of the exercise, right? We're going to fix that. And for the change, that's literally zero. So in other words, we're shutting down the macrofinancial feedback effect to get just the response of capital to changes in the other two variables, which is, again, similar to what we do in the typical stress testing exercise. Doing that, we observe that the system is able to replicate remarkably well the aggregate path of bank capital in the stress testing exercise. Let's say tier 1 capital over risk-weighted assets. So in our framework, the tier 1 capital ratio declines from 14% to about 10.8%, so almost 3 percentage points, which is pretty close to the decline in bank capital from start to minimum that we observe on average over 7 years of CCAR exercises, which is about 2.7%, so close enough. Armed with this framework, we're going to compute then the difference, as I said, or the macrofinancial feedback on GDP growth between a model that shuts down the responses, this is the restricted model, and the unrestricted model that allows for all the feedback, right? That difference, which we call the macrofinancial feedback effect, is shown here in red, both for the 5th percentile on the right and for the median of the distribution. And we can see here that in terms of the GDP path, the macrofinancial feedback is about 2 percentage points for the median, but it could be up to 7 percentage points for the 5th percentile. We can do a similar exercise comparing the path, again, in the restricted and the unrestricted models for bank capital so that we can obtain, right, the amount of additional capital that the system will need in order to offset the macrofinancial feedback. So, and that is what we call a capital surcharge. And in our estimates, we obtain about 1.5 percentage points for the median, for example, shown on the left in this slide. And that will be, again, necessary to offset the 2 percentage point decline, additional decline in GDP growth given by this amplification of the banks to the shocks that we have in the stress test scenarios. So now we need to link this concept of the additional capital that the economy needs to macrofinancial vulnerabilities. And as I said, we're going to use the concept of growth at risk to link the macrofinancial feedback with microfinancial vulnerabilities. And as you might recall, this is the work that Tobias, Adrian, and co-authors developed. The growth at risk is a forward-looking estimate of downside risks, right? So it gives you sort of like a time-varying metric that depends on the state of the economy. It's, if you want, you can think of like the conditional GDP growth on the tails of the distribution, say the 5th percentile. And that is giving you sort of like the likelihood of a probable bad outcome like a recession. So given that we have this model, we're going to compute conditional on the current state of the economy, the GAR metric, right? That will be the conditional GAR. And we can do the same thing for, let's say, the long-run trend, which we're going to call the growth at risk unconditional. And for that, we're going to just use, if you want, the mean of the variables, the distribution of the variables in our sample. The difference between the conditional and the unconditional GAR, you can interpret as the difference between cyclical versus structural vulnerabilities. So that is going to give us, if you want, a countercyclical, state-dependent, and risk-based measure for the capital surcharge. This is, in graphical terms, what I mean. So this figure shows both the conditional GAR in dashed red lines and the unconditional GAR in black. As you can see, the unconditional GAR, first the conditional GAR shows more variation at high frequency. The unconditional GAR shows a path that is ham-shaped around the financial crisis, as you would expect. The difference between the two, which is the gap, could be positive or negative. The green areas show the positive values and would indicate periods of expansion, most likely periods in which vulnerabilities might be building up. And that will give an indication of when to activate, if you want, the capital surcharge, which in the context of what I'm just saying, would be sort of like to manage macrofinancial vulnerabilities. We can see that the movements are more extreme and pronounced at the 5th percentile than at the median. And interestingly, we also see that financial vulnerabilities, as you would expect, are much more significant in periods like the financial crisis between 2007 and 2010. We also see some negative vulnerabilities around the European sovereign debt crisis in 2012, and some of that during the oil crisis shocks in 2015 or 2016. Oops. So, as I mentioned, this framework would allow us to provide a guidance to when to use the capital surcharge in the context of macrofinancial vulnerabilities. And this is what I'm showing here. So if you take the growth at risk gap that I showed you in the previous slide, the 5th percentile, this is going to be some sort of like a menu of options for the supervisor. If the supervisor is risk averse and wants to hedge the economy against, let's say, the 5th percentile rather than the median, we can think of the capital surcharge being activated during the green periods, right? What we do is we use the model and compute the macrofinancial feedback at every point between 2002 and 2020, for example, and we see the size of the capital surcharge that the economy needs precisely to offset the macrofinancial vulnerabilities that the GAR gap is indicating. So the GAR gap here would also provide, if you want, or inform the regulator when to activate this capital surcharge or countercyclical capital buffer. So our estimates indicate, for example, that for the first green area, if you think of it as what would be the level of the CCYB in the pre-crisis period, our estimates indicate that about 190 basis points would be sort of like recommended according to this framework. In the post-crisis, our estimates indicate that for the median of the distribution, the CCYB would be about 210 basis points. That's for the median. If you think of the fifth percentile, pre-crisis, the CCYB would be around 460 basis points, so that's 4.6 percentage points if you want. In the post-crisis, that will be 510 basis points. So, and this is, I guess, the last slide to wrap it up. We are developing a relatively straightforward methodology to augment the current stress testing machinery, right? In order to include this idea of macrofinancial feedback and the calculation of a capital surcharge to offset the macrofinancial feedback. We're going to use this metric, or we proposed using this metric of the growth at risk gap to indicate or to guide the activation or deactivation of the CCYB. And as we argue here, this is applicable to any stress testing approach, macroprudential, different severities, different planning horizons. We can use, like in CCAR, 9 quarters, or we can use like 2-3 years as in the IMF stress testing framework. And this should be easily adopted by supervisors worldwide. With this, I'll stop here.
Thank you very much, Jose, also for sticking to the time frame. The discussion is Loriana. Loriana, the floor is yours. You want the pointer.
Yeah, I'm sorry.
Thank you.
So, thank you very much for inviting me to participate to this fantastic conference and also to discuss this very interesting paper. I think that Jose did a great job in presenting it, so I'm just giving, an overview of what this paper is, talking about and what is the main objective. So, first of all, it is a parsimonious model that want to capture really a lot of things. So one is the dynamic relationship between bank capital, financial conditions, and GDP growth. And second, want to quantify the causal impact of shocks to bank capital and also on the future distribution of financial condition and future downside risk to GDP growth. So clearly, the aim is to set up a framework that is manageable, easy to implement, but that really try to assess from the causal point of view, not just correlation, how much bank capital might have an impact on, let's say, the downside risk due to financial condition and mostly can generate, let's say, downside GDP growth. And on the other side, they try really to estimate macrofinancial feedback effects. That's the key objective of the model. But not just because we want to see what are these type of feedback effects, but because they want, in some sense, to provide a framework that supervisor can use in order to calibrate a counter-cyclical capital buffer that will be able to account for the vulnerabilities in the context, of course, of the bank stress test. So it is really trying to provide a framework where you can do bank stress tests to figure out how to fix counter-cyclical capital buffer. So when it is the right time to increase the capital buffer, and then at which level, and at which level then you should reduce it during, let's say, when there is some downturn of the economy. So as you can see, it is a very ambitious paper, and I think that Jose managed very well to present in details the different parts. But now I'm not able to move anymore to the next slide. I don't know why. Okay.
Probably no.
Yeah, so what are the main results? Clearly, the main result of this paper is that you can tangibly assess the feedback, how relevant are the feedback effects, that the growth and risk gap shows that more time variation, then this is something that you didn't present in the paper, but clearly, the other possibility is that the countercyclical capital buffer is related to the credit gap, so how much is increasing credit with respect to the GDP growth, and based, in some sense, the idea that you can increase capital requirement when there is a sort of surcharge of the economy. Well, they're showing that their approach, is preferable because, in some sense, is able to capture cycles at a higher frequency than the business cycle. And they provide also some number, how much should be the countercyclical capital buffer, 210 basis points for the median and 510 basis points if you are really risk averse and want, to try to reduce as much as possible the impact of the bank capital on the cyclicality and of the economy. So I'm not spending other time on describing the paper. Clearly, it is very interesting. I think that the idea is very good, mostly because it's really providing a framework to capture feedback effects, dynamic, and the results are extremely interesting. But clearly, I need to play my role, and my main comment, the first one, is that, when we are really looking to feedback, we need to be sure that we are really measuring causality and not just correlation. And clearly, the large part of the result of this paper are based on the estimation of the lead-lag relationship as well as the contemporaneous feedback between three variables. One is bank profits, that is, the dynamic of capital, financial condition, and GDP growth. They are, in some sense, claiming that they are able to capture contemporaneous Granger causality that per se means nothing, because if you remember what is Granger causality is telling you, is trying to measure how much the, let's say, yt plus one variable is related to some lag variable, so y other, let's say, lag variable on top of the same variable. So clearly, there is a Granger causality is based on lead-lag relationship. So pretending that what you find in terms of Granger causality of the lead-lag relationship via pairwise variables represent the type of connection that you can also observe contemporaneously. Well, this is maybe stretching too much what the Granger causality test is going to tell. And in fact, when they're looking to the contemporaneous, let's say, analysis, they are referring to this, the paper of Caselli that is looking to the conditional joint distribution. But if you're looking to the paper of Caselli, is really trying to estimate conditional correlation in some sense. There is, Caselli et al. Is never mentioning the word causality in their paper. So I think that it would be good if the author can spend a little bit more time in justifying the approach, or maybe propose another one that is able really to capture in a solid way, in a convincing way, this type of contemporaneous causality among the different variables. As I say, the authors are using the Granger causality to assess the lead-lag relationship, but and it is just between pairs of these three variables. However, there are no statistical and also other type of justification of this assumption that what you find with the Granger causality is also capturing contemporaneous relationship. And, the impression that I have is that this temporal causality also, so also regarding the Granger causality that they are estimating, could be simply due to the different nature and frequency of the variables that they are considering. So they are considering financial condition that are extracted from, let's say, stock price return, interest rate, term structure, and so on. And by nature, these variables are forward-looking. So when we are then putting this type of variable in relationship with GDP growth, that we are going, to account quite later, or accounting data like bank profits, well, maybe you are just finding some statistical relationship because these variables are of a different nature, not because bank capital do granger cause GDP growth in the next period. And that's why I think that it will be very good if the author can provide some, let's say, economic justification on top of the statistical regression of why, you are getting this type of relationship that shouldn't be just related to the different characteristics. So the fact that some of these variables are coming from accounting data and some other are coming from, market data that are by nature forward-looking. Yeah. On the other side, I think that they can also do, let's say, an effort to have a similar variable together. So, for example, they can use now casting GDP growth that they can combine with the financial condition variables, as well as maybe using analyst prediction for bank profits. So in this way, there will be all variables that are instantaneously determined in the market. On the other side, I will be very curious to know from one aspect how robust are the results. So if I'm changing some of the parameters that you are going to estimate, given that you have estimation error, you are using quantile regression, so the number of observations that you have are very limited. How much the results are robust to a perturbation, for example, of the coefficient. And also, if you're using a simple VAR rather than the contemporaneous lead-lag relationship, or a structural VAR, or a Bayesian VAR, how the results are different. Still, I believe that the three variables that you are using are extremely important. But maybe using a simple VAR, you get already the result that you need, and you are not having all the problem that you are generating by making this assumption of contemporaneous causality. Then, clearly you are calibrating your model in a period where there are several things happening, including monetary policy and fiscal policy, that, QE and so on. So how are you really then using the number that you are able to calibrate, and what type of assumption are you making when you're doing then bank stress test scenarios? Are you still assuming that monetary policy and fiscal policy will be the same in the future, or is there any way to clean up this part? And moving then to the countercyclical capital buffer in your prediction, it's true, you have a fantastic model that is capturing the dynamic, but it seems maybe too much dynamic for a regulator, because, we know that assuming that as a regulator you are going to change quite frequently the level of the bank capital requirement, this will create uncertainty. And therefore, the benefit that you are going to have by relaxing the capital requirement maybe will be not really beneficial to the economic system, because banks then have the uncertainty of when you are going to re-increase the bank capital requirement, so they are not even using it. So maybe it will be nice to understand what is the right frequency through which this countercyclical capital buffer should be changed. But anyway, thank you very much. Very nice paper, and I'm suggesting to all of you to read it.
Thank you, Loriana, for the discussion. Jose, maybe you want to respond briefly, just to keep time for the overall discussion.
No, thank you very much, Loriana, for very insightful comments. Just a couple of responses, I guess, to the multiple comments. It is true, and I apologize because I guess I gave you a preliminary version. We've been working, as I said, this is work in progress, and we need to streamline the exercise to make it more clear exactly what is it that we're doing. It is really complex to try to estimate, do the density estimation. And yeah, the Caselli paper is actually a motivating paper, just to say that there are multiple methods that you can use to estimate densities. And we don't use it, actually. It's just to present the idea that this is a complex system with multiple nonlinear relationships. But I agree with you, we need to tighten some of the knots of the framework. The gradual causality tests are used not to solve the, we need causality here to be able to say something meaningful about policy. But the gradual causality tests are essentially used for identification purposes more than to solve any endogeneity problem. Endogeneity we address with the granular instrumental variable approach. So we needed some assumptions like the ordering. This is so complex that we need to take a lot of assumptions and shortcuts, and ordering and supporting the ordering was just one. And let me just answer the last question about the CCYB on potential uncertainty. I'm not sure about adding more uncertainty. One of the characteristics of the current stress testing and capital regime in the US is the so-called stressed capital buffer, which is the result of an outcome that comes from the stress test as well. So we are mixing annual exercises with point-in-time regulatory requirements, and we don't see any additional uncertainty coming from using exercises like the stress test every year. So it is not really clear that we're going to add more uncertainty to that.
Thank you very much. I see at least one hand up. Okay, please. Giovanna, Nicodano, once you get the micro.
I have two questions. One concerns the stability across subsamples, and I don't know whether it is feasible with the observations, because that is quite subtle a problem in view of policy implementation. So are the parameters stables across subsamples? And the second question is that the approach is an autarkic approach, as if the US were independent from economic regulation and economic facts happening elsewhere. Whereas I presume that what matters a lot is also the differential capital imposed in the US and elsewhere on the competitive scenario, GDP growth, and so forth.
Maybe
I know that the data are limited, but...
Thank you, Giovanna. Maybe we collect more questions and then I give you the chance to respond to all of them. So, Rafael?
I have two comments. The first one is about the rationale for what you're doing. I mean, you estimate these macrofinancial feedbacks, and then the objective is to adjust this capital surcharge in order to offset the macrofinancial feedback. Now, as a sort of a strange kind of objective, so I wonder if you can relate this to some sort of, I wouldn't say welfare, but some sort of justification for why fully offsetting this would be the best thing that you could do from a policy perspective. That's number one. And number two is about Loriana's variability of these surcharges. Okay, you're saying that you're doing this every quarter, right? But of course, if you were to raise from 0 to 200 or 500 basis points, then that wouldn't be. And let me remind you that in the Basel III CCYB, you were supposed to announce these sort of increases with 1 year lag. So, and presumably you could also do that in your framework, right? To sort of delay the implementation and see whether this is something that goes against these offset of the macro-financial feedbacks.
Thank you, Rafa. Ansgar?
Thank you. I've always been interested in the Lucas critique with stress tests. So if you say to them, if I run my model and I find a lot of macro feedback, I'm going to put up your capital. And they're going to study to satisfy your model in some sense, right? At least if banks know what they're doing to some extent, there will be some margin at which they can adjust it. And then if you ran another model after that, you might find that feedback has actually not gone down. They've just, adjusted to a particular model. And so it's kind of tricky to understand. Once you take that incentive into account, how should you adjust the capital surcharge? And it comes back to Rafa's point about welfare. What in the end are we trying to maximize? I was hoping to get your thoughts. Thank you.
Okay, we are really tight on the schedule, but I have a couple of questions myself. So one is that I think there are two parts in the analysis. One is the very interesting analysis of the dynamic interactions between these three relevant variables of your system, of your triangular system. I think that's quite informative about what happens at the median and what happens at the tails regarding these indices, with potential concerns on the truly exogenous or not element in the detected impacts. I was wondering when you said that you were assuming this particular triangular structure, whether that was coming out of a preliminary analysis or out of essentially logical imposition. So how is it an assumption relative to something that can be justified on either empirical or theoretical basis, and maybe connected to something Loriana said is if instead of this triangle you use another, you get, I guess, very different results. And my second point is related to questions that both Rafa and Ansgar had formulated. I will formulate in closer terms to the model structure itself. So you have these three equations where you detect how much the variation in capital affects the other elements of the system. So I understood your proposals for the calibration of the CCYB as having a regulatory way to offset the losses that the adverse scenario will impose in terms of capital. But then I wonder, having a capital buffer in advance of the size of the losses that are coming is not the same as not having the losses, right? So if you implement your CCYB requirement, you will have your banks with more capital in good times, and indeed then when the capital losses are realized, that bigger capital will go down by exactly the same amount as in the current analysis. But then to claim that, in a sense, there is an underlying claim that the level matters, but your formulation is with variations in capital. So I wonder whether there is a way to reformulate the three equations model so that in addition to the capital losses, it matters at which level you register those losses. Because my interpretation is that the capital buffer calibration makes sense if registering the same losses with higher levels to start with, we're able to produce lower implications. Don't feel obliged to respond everything, but please react a couple of minutes.
Yes, so thank you again all for the good questions. Let me start in a backward fashion from your questions first. So indeed, the level of capital matters. And in the revised version, as I said, this is working paper. We've had some similar questions. It is really difficult to try to capture the upward trend and do not see that reflected in the calculation of the CCYB. So we are including interaction terms now to account for the fact that it might be different when the capitals are well capitalized, when they are not, whether you want to activate or not the CCYB. So point well taken. The logical imposition of our ordering, as in any typical time series framework of VAR, we tried different ordering, and in the end it becomes sort of like an assumption to help us with the estimation again of the conditional densities. We try to provide a little bit of an intuitive explanation for that, but again, it's simultaneous determination. What causes what? That's the tricky part, and we address that separately, not through the imposition of an ordering, which is more, again, for operational reasons, just to have assumptions, workable assumptions for the estimation. Definitely, the not having a structural model makes us subject to the Lucas critique, and we do acknowledge that as a caveat in the paper. You're totally right. It might be the case that, indeed, our parameters are not policy independent. You propose a policy, you implement the policy, you will need a different model to estimate the impact. So, and this goes to Rafa's questions as well. Activation, we had that discussion as well. Indeed, the CCYB framework contemplates a one-year announcement. And what we think of is, in the green areas, if you recall the figure, when you think that the gap is increasing, that's precisely the period when the regulator is going to be measuring, a potential buildup of vulnerabilities. That's the period when our framework would suggest to announce that the regulator will raise the CCYB the following year. Most likely, the banks are going to take care immediately of that announcement, and they're going to, reduce probably the excessive leverage or risk-taking that they might be doing. I don't know whether that answers the question. The rationale or justification. So the main idea is that the macrofinancial vulnerabilities that we're identifying would include the feedback effect that we're computing, which results from the fact that the banks might not be operating with sufficient capital. That's literally the main assumption, the fact that part of the vulnerabilities we identified is just the fact that the banks are not operating with enough capital. And we need to raise that in advance, if you want, through this framework. I guess I can answer.
We are late. Yes, thank you very much. Sorry for rushing. This is a packed last session. So I invite the presenter of the next paper to come up. Also, Giovanna. Thank you, Loriana, and thank you, Jose. Hello, thank you for being here. So our presenter is David Elliott. He's presenting Separating Retail and Investment Banking Evidence from the UK. 20 minutes, the floor is yours.
Thank you.
And here is the pointer.
Great, thank you. And thank you, first of all, to the organisers for having me here. It's a great pleasure to be here, particularly in person. So thank you for including me on the agenda. The paper I'll be presenting today is indeed called Separating Retail and Investment Banking, Evidence from the UK, and this is joint work with my colleague at the Bank of England, Mathieu Charaz. Now, of course, as we're both in the Bank of England, I should start with the usual disclaimer that these are our own views and not necessarily those of the Bank of England. Okay, so the big picture question to which we hope to contribute with this paper is basically whether universal banks should be allowed to combine retail and investment banking within one institution, or whether these activities should be separated. Now, as you'll all know, this is a very long-standing policy question in banking. It goes back at least as far as the 1930s, when the Glass-Steagall Act banned universal banking in America, and has been essentially debated since then. So, as you'll know, these restrictions were largely reversed in the 1990s in America, but still kind of live on to some extent. And in particular, consensus remains elusive. So despite all these decades of debate, there remain major divergences across jurisdictions. So in America and Japan, there are still requirements that require banks to some extent separate their retail and investment banking activities, whereas in Europe and Canada, these can essentially be combined in one integrated universal bank. And the debate continues, so prominent politicians on both sides of the Atlantic, including Joe Biden, are continuing to call for further reform in this area. And despite all of this debate, we think important evidence gaps remain, and this is not surprising. So there are very few kind of exogenous shocks to the structure of universal banks, which makes it difficult to obtain reliable empirical evidence. So in this paper, before I go into any details, I'll just give you a quick summary. In this paper, what we do is we study a major recent UK banking regulation, which is referred to as ring fencing. Now, essentially, this regulation required large universal banks to separate their retail deposit taking and investment banking activities into separate subsidiaries. Now, what we focus on is the potential so-called deposit funding channel of ring fencing. Now, the idea is that because the regulation implies that universal banks can no longer use retail deposits to fund investment banking, if it's the case that retail deposits have some advantage relative to other funding sources, then this should affect banks' asset allocation decisions and hence credit allocation across different markets. Now, we find two sets of empirical results consistent with this idea. So first of all, we look at the direct effects on treated banks. What we find is that universal banks rebalance away from capital market activities and towards retail mortgage lending. We then turn to spillover effects on the wider mortgage market. So given that these large universal banks are now doing more retail mortgage lending, we find, first of all, that this increases concentration in that market. And then in addition to that, we find that the smaller competitors competing with these large universal banks, in response to this increased competitive pressure, they increase their own risk-taking. Okay, so there's a large empirical literature already in existence that debates the implications of separating retail and investment banking, and I've listed here a few of the key papers in that literature. We aim to contribute by taking the literature in three new directions. So first of all, and probably most importantly, we document a new mechanism related to universal banks' funding structures. So existing papers typically focus on the combination of lending and underwriting within a bank, and therefore focus on the asset side of the balance sheet. What we're doing is looking at the implications of creating additional constraints on the liability side of the balance sheet, and in particular related to the use of deposit funding. We think this is an important aspect to consider because a lot of the recent policy debates about these kind of regulations emphasize the potential for the benefits of deposit funding to accrue to capital market activities, and this is a concern that's in the mind of several recent proponents of these types of regulation. Secondly, we show an impact on both retail and corporate lending. So existing papers typically focus only really on more wholesale activities, so corporate lending and securities markets. But in recent years, universal banks have played an important role in retail credit markets as well, and there's basically very little evidence on the implications of that. So we try and provide the first evidence really in that direction. Finally, we estimate direct effects on universal banks themselves, but also spillover effects on their competitors. Okay, so in order to do all of these things, we study this major recent UK banking regulation called ring fencing. Now, the main thing that ring fencing does is it requires large banking groups to split into subsidiaries. In particular, they must put their retail deposits in an entity subsidiary called the ring-fenced bank, or RFB, and they must put their investment banking activities in a different subsidiary called the non-ring-fenced bank, or NRFB. And then these two subsidiaries have to be separately managed and separately capitalized. In addition, the regulation imposes various restrictions on intergroup exposures that prevent universal banks from kind of circumventing these requirements via intergroup contracts. The legislation was passed in 2013 and came into force at the start of 2019. Now, there is a size threshold, so it only applies to banking groups with at least £25 billion of retail deposits. In practice, that means it captures the 5 large UK universal banks. Now, the motivation for the regulation was, as you can anticipate, around financial stability. So the idea was that by separating these two parts of the bank into separate subsidiaries, it would make it easier to resolve the investment bank separately from the retail bank. In turn, this would reduce the probability the government had to bail out the investment bank in order to save the retail bank. And in turn, this should, in theory, reduce excessive risk-taking by the investment bank because it would remove or at least reduce some implicit subsidies. Okay, so just to make this a bit more concrete, this figure shows a stylized example of what the regulation does. So on the left-hand side, we see a kind of simplified picture of a universal bank before ring fencing. So on its asset side, it has both retail mortgages and also some investment banking. and it's funded by a combination of retail deposits and wholesale funding sources. We're ignoring equity here for simplicity. Then on the right-hand side, we see what happens once the ring-fencing regulation is implemented. So the key thing is that the retail deposits, so the yellow box, have to be separated from the investment banking, the green box. So retail deposits have to go into the ring-fence bank, and that means they can only essentially fund more retail activities, in this case mortgages, and the investment banking must go into the other subsidiary, the NRFB, and because it cannot be funded by deposits, it must now be funded by wholesale funding. Okay, so the aim of this paper is to investigate what we call the deposit funding channel. So by design, this regulation reduces the potential for investment banking risks to infect the retail bank. So the investment bank can probably now be resolved more easily, separately from the retail bank. And that's not really something that we're focusing on. What we're focusing on is more these kind of sort of maybe second round effects. So by imposing these new constraints on the funding structure of the bank, this regulation is likely to change their optimal asset allocation across different activities, and this is going to have implications for credit conditions in different markets, and that's what we focus on in the paper. In particular, we hypothesize that this so-called deposit funding channel is at play. So the underlying idea is that retail deposits might provide certain benefits to the bank relative to wholesale funding, and there have been various arguments in the literature for why that might be the case, for example, due to households' preferences for liquidity, also to deposit insurance and market power in deposit markets. Now, if that's true, if retail deposits do have these benefits, then what does this mean for ring fencing? Well, ring fencing implies that these deposits can only fund the RFB now, they cannot fund the NRFB assets. And so to the extent that there are benefits to the retail funding, these will all be now channeled into the retail side of the business. So this is likely to lower the RFB funding costs and increase the NRFB funding costs, which would in turn provide an incentive for the bank to rebalance away from the NRFB activities, so that's the capital market activities, and towards the retail activities in the ring-fence bank. And this is the hypothesis that we aim to test. Now, industry commentary is generally supportive of this hypothesis. So here we have some headlines from the Financial Times and the Bank of England arguing that ring fencing incentivized these banks to expand more into retail lending. And also we have some anecdotal evidence from Reuters arguing that ring fencing increased the cost of syndicated lending. Okay, so now we'll go into more detail. So our empirical strategy is to investigate credit markets, one on each side of the ring fence, and in both cases we use loan level data. So on the retail side, we'll look at domestic retail mortgages using a data set called PSD, which captures the universe of UK retail mortgages at the loan level. And on the NRFB side, so the capital market side, we look at global syndicated lending. Now, our sample period is 2010 to 2019. So as you might recall, the regulation was announced, or the legislation was passed in 2013, but only came into force in 2019. So what we're doing here is not looking at a simple pre-post, but rather looking at how banks anticipate the regulation, and so our sample period is basically the run-up to the implementation. The underlying idea, which I'll say a bit more about in a second, is that to the extent that banks are forward-looking when they originate long-maturity loans, they will take into account the funding cost over the lifetime of the loan, and so take into account these future changes in funding structure when they originate a loan today. So we run various regressions of this general form. So in general, I refers to a bank, L refers to a loan, and T refers to the time, so month or quarter, for example. Our dependent variable, loan, will be either the price or the volume of loan L originated by bank I at time T. And then our treatment variable is this interaction variable between these variables referred to as delta retail funding and percent post. So delta retail funding is a change in the retail funding ratio that the bank experiences as a result of ring fencing. So this gives us a between-bank measure of how much a bank was affected by the regulation. And percent post is defined as a proportion of the loan maturity that falls after the implementation of ring fencing. So this is basically capturing the degree to which a given loan would then be affected by the change in funding structure. Now, I'll say a bit more about both of these variables in a second. But one key thing to highlight is that because this percent post variable is defined at the loan level, it provides us within bank variation, and this means that we can include a very rich set of fixed effects in our controls, including bank time fixed effects, which should control for a lot of other shocks that could be differentially hitting these different banks. Okay, so now just spend a little bit more time on those two parts of our main interaction variable. So this delta retail funding variable is our bank level measure of treatment intensity, and it's defined as the change in the retail funding ratio of activities on each side of the fence. So to give you an example, on the left-hand side, we again have our bank before ring fencing is implemented, and in this case, its funding structure is made up 60% of deposits, so its retail funding ratio is 60%. After ring fencing, the retail deposits all go into the RFB, and the investment banking goes into the NRFB. So in the retail funding side, or so on the RFB side, now deposits are making a higher proportion of the funding structure. So basically, the retail deposit ratio has increased to 75%. So for the RFB, this delta retail funding will be 15 percentage points because it's increased from 60% to 75%. Whereas on the NRFB side, it's lost all of the retail deposits, so it's gone down to 0% retail funding. So for this, on this side of the fence, the delta retail funding variable will be 60 percentage points to reflect this reduction in deposit funding. And then the second part of our main interaction variable is this variable called percent post. And so this is our loan level measure of how much a given loan is affected by the change in funding structure captured on the previous slide. Now, this is based on maturity. So the variable is defined as the percentage of the maturity of the loan that falls after the implementation of ring fencing, so it falls after the start of 2019. So for any loans that mature before 2019, they'll have a value of 0 for this variable. For any loans that are originated after 2019, will have a value of 1. And loans that originated before 2019 but mature after 2019 will have a value of between 0 and 1. And the basic point here is that if a bank is originating a loan, say in 2017, as in the example on the slide, but it will mature after 2019, they won't just take into account the current funding cost of the loan, but instead they'll have to consider the funding cost over the full lifetime of the loan. And that will reflect the fact that when 2019 hits, there'll be a change in the funding structure of the bank. Some loans will move into the RFB and will therefore experience an increase in retail funding. Some will move into the NRFB and therefore experience a reduction in deposit funding. This will imply changes in the future funding cost of the loan, and these should be taken into account by the bank today when it's originating the loan. Okay, so to go into to move towards the actual results, what we do is, first of all, we look at the retail mortgage side of the bank and test whether there's an increase in credit provision there, and then we look at the capital market side and test whether there's a reduction in credit provision. So on the mortgage side, we start off by asking whether ring fencing caused affected banks to cut their mortgage spreads. So we run regressions of this form. So it's the regression I showed you before. In this case, the dependent variable is the credit spread on mortgage I. We include a rich set of fixed effects, including bank time fixed effects to control for a lot of other shocks hitting the bank. We also include product time fixed effects and others, as well as loan level controls and bank level controls. And these are our results. So the different columns basically reflect different combinations of fixed effects and control variables. And actually the last two columns, so one thing I forgot to mention, but this delta retail funding variable, we can only measure it once ring fencing comes into force. So this has a degree of endogeneity. What we do is we instrument it using variables determined before the legislation was announced. So that's what the last two columns are capturing. But across all of these columns, what we find is that there is indeed a negative relationship between this interaction variable and credit spreads. So what this means is that banks who are more affected by ring fencing in terms of having to undergo a larger change in funding structure cut spreads more, and particularly on loans that had a maturity that would extend further beyond the implementation date. So this is consistent with the idea that ring fencing did indeed lead to a reduction in mortgage spreads. We then turn to quantities. So we ask whether these cheaper mortgages led to higher quantities by these affected banks, and we do this using market shares. So basically we define market shares at the level of different products. So by product, what we mean here is the interaction of maturity and LTV. So for example, it could be a typical product would be a 5-year mortgage with 75% LTV, for example. For each bank, we compute their quarterly market shares in each of these products, and then we run essentially the same regression as before, but this time on our left-hand side, we have the market share at the product level. What we find is that the market shares increase for those banks more affected by ring fencing. Again, this holds across a range of control variables and using both OLS and IV. So indeed, we seem to have evidence that ring fencing is leading these banks to increase their mortgage credit provision, and that's reflected both in a reduction in price and an increase in quantity. We then turn to the other side of the fence. So the capital market side. So this is now the bit that's losing the retail funding. And so for this market, we look at syndicated loans, a market which has been discussed already a few times this week. So as you know, these are loans extended to one borrower by multiple lenders, and typically these are large corporates who are the borrowers. We run some different regressions in this market, but the one I'll kind of focus on is this intensive margin regression. So here we're able to exploit the fact that different banks are lending to the same corporate at the same time within a given loan, and so our left-hand side variable will be the quantity of credit provided by a given bank within a particular syndicate. What this means is that we can include in our control variables this variable delta L, which is the loan fixed effect, and this controls the credit demand in the kind of Quasi-Mian tradition. What we find is that the banks more affected by ring fencing do reduce their loan quantities within a conditional on lending. They lend lower quantities, so this is a reduction in the intensive margin. We also find that they participate in fewer loans, consistent with a reduction in the extensive margin. And we find this effect is larger for loans to foreign borrowers. I think I'm almost about to run out of time, so I'll quickly go over the last set of results. So far we found that ring fencing seems to lead banks to rebalance away from corporate lending and towards retail lending in the mortgage market. We then test whether this has spillover effects on the wider mortgage market. We do two things here. First of all, we test whether the increased lending by these large banks leads to increased concentration in the mortgage market. The way we do this is we measure, we construct a measure of exposure to ring fencing at the level of local geographies based on historical geographical lending footprints. And indeed, we find that banks with a greater historical reliance on the ring fence banks, indeed, so county or regions with a greater historical reliance on these ring fence banks, they become more concentrated in their mortgage provision. And then finally, we find evidence that this increased competitive pressure from the large banks has impacts on the smaller banks who are competing against them. So again, using a kind of historical measure based on historical lending footprints, we construct a measure of how exposed a given small bank is to the competitive pressure coming from the increased credit provision from the large banks. What we find is that the small banks who are more exposed to this competitive pressure, they increase the riskiness of their lending. This seems to be consistent with the Keeley model, because it could be that these small banks are losing some franchise value and are therefore risking up. So that brings me to the end of the presentation. Just to kind of recap, what we find, the main contribution is evidence of this deposit funding channel of this type of regulation. In particular, banks unable to use retail deposits to fund capital market activities rebalance away from capital markets and towards retail lending. So there's various potential policy implications. First of all, it suggests that these types of regulation reduce the cost of credit for consumers, which is not something that's really come up in the literature before. This is, of course, reflected by an increase or reduction in credit provision to corporates. What we do find is that, at least in this case, this was largely focused on foreign corporates rather than domestic corporates. And finally, we find these ambiguous impacts on the retail credit market in terms of increased market shares for large banks and increased risk-taking by small banks.
Thank you very much.
Thank you very much.
Just in time on very informative presentation. So the discussion is Giovanna Nicodano from University of Turin. You want the pointer, I guess.
Yes, please.
Well, thank you for inviting me. I found this conference extremely interesting, Madrid charming as usual, and there was also allocated a very thorough paper, which is like been, it benefited from comments, from earlier comments a lot, as you can just glimpse from the presentation. The question is the response of credit availability and credit standards to the ring fencing of retail banking that occurred due to the Vickers reform in the UK. And this reform separated out investment banking activity from retail banking. And they have an ingenious identification method. And although I'm not going to pause a lot on the details of the identification method, suffice to say that it is using the data concerning the large banks that were the target of this reform, leaving outside the smaller banks that could stay universal, could stay like, were not the target because they were below the threshold of 25 the threshold established by the Vickers reform. And so this allows the authors to also measure the spillovers of the ring fencing of the affected banks onto the smaller banks that were not the target of the reform. And the results are that the mortgage spreads fall for the ring-fenced bank. They fall more on the mortgages that were falling with the maturity past the implementation of the Vickers reform. And the market share of the ring-fenced banks increase. Smaller banks have to compete aggressively on spreads, and especially for the high loan-to-value mortgages. And hence, you can see that there is a clear-cut spillover effect from the ring-fencing of the affected larger banks onto the smaller banks. And then there is this side effects on the reduction of syndicated loan origination. Now, the channel through which this obtains is the reduced availability of the deposit funding for the syndicated loan business and an increase in the availability to the ring-fence banks. Now, I think this is very interesting. The question is interesting not only from a policy point of view, but a general point of view. There are very good data and the careful analysis, clearly identified contribution to the banking literature. I think the theoretical underpinning for the method they use, this focus on the deposit funding, could be improved, and I think that their result on the competitive spillovers of ring fencing is interesting per se, aside from the policy effect, and so should be stressed more. So in this discussion, I will first try to help strengthening the underpinning of the deposit funding channel. Then I will ask a few questions on syndicated loans, and finally I will add some thoughts on further work concerning the separation of retail and investment banking. Now, there is this extensive literature on internal capital markets, and there is a sequence of papers by Giacinta Cestone and co-authors that focus precisely on multi-market spillovers generated by the creation of the internal capital market. What they study is when you have two separate units and you put them together, you created the internal capital market. You can think of ring fences as the opposite kind of operation. And so while they study how internal resources are reallocated to the affiliate in response to changes in prospective markets, and how this affects their affiliates' competitive behavior, you can simply reinterpret their result. So, to give you an example, prediction 1 is a market displays lower entry rates when incumbent affiliates have larger cash holdings, okay? Now, think of cash holdings, internal cash holdings, as your deposit funding, which, similar to internal cash holdings, has a relatively lower cost, more stability, etc., etc. And this, I think, can explain why smaller competitors in the mortgage industry exit when the ring-fenced bank activities rely on these larger deposit funds, thanks to the fact that internal investment banking activity no longer can have claims to them. So now, this kind of reasoning could also explain the results, in the mirror image result on syndicated loans, because the syndicated loans rely on less deposit funding. But here I have some questions, because what I don't understand is the reason why were syndicated loans, that activity, moved to the non-ring-fenced business subsidiary when it was possible to keep them within the ring-fenced activity, benefiting from the deposit funding. And so I list some conjectures. One possibility could be the prohibition for the ring-fenced banks to operate outside the European area, but this is just a conjecture. The conjecture I'm more interested in, and given time constraints, I would just focus on, is the last one, which is, but is the reduction in syndicated loans really real or apparent, especially the one which is the larger one for the foreign borrowers? And the reason I'm asking this question is that there are the papers at the IMF that study precisely the contraction in global banking activities by what they call core lenders that include the UK, that were prompted by macro-pru policies. But they observe that they were compensated by an increase in local subsidiary lending that substituted for the direct foreign lending by the UK headquarters, let's say. And so I know that you use loans at the parent company level, so that would suggest we can rule out the increase in the lending by the foreign local subsidiaries, but since the balance sheet referred to the UK entities, I'm not sure. And finally, but if we can rule out that this reduction is simply apparent, then it is clear that it would be just an increase in competitiveness in the mortgage business without much reduction in the syndicated loan business, with a mirror reduction in the syndicated loan business. Finally, the motivation for the paper is some policy assessment of the Vickers reform and this ring fencing of activities. And I was surprised by the words of Vickers in motivating this step, which were focusing on reducing essentially the incidence of bankruptcies or bailouts. And so here are some thoughts on some other literature on internal capital markets that looks at endogenous bankruptcy of these conglomerates or separated subsidiaries, etc. Because like Vickers refer, like separating out investment banking would help resolve banks, help them shield from financial shocks, reducing the expectation of bailouts. So I think the endogenous bankruptcy is an integral element. This obviously has to do with future work, not with your paper today. And I apologize for citing also some of my research. And I think here there are the original results by Leland that says that splitting a conglomerate into separate units insulates each unit from shocks, but prevents each unit from supporting each other. And so the effects are mixed. But later papers show that splitting a conglomerate into subsidiaries that are separately incorporated, which is similar to what the Vickers reform is doing, is gonna allow for shielding from shocks while allowing at the same time to support the subsidiaries, but just if this is possible without going into default. So joint default is going to be reduced at the same level of debt. And of course, there is also an incentive to increase debt, but here the leverage constraint would help. So, but this is just future food for thought. And coming back instead to the paper, I think it is a very stimulating reading, careful paper. Robust evidence that ring fencing retail banking is associated with competitive externality, and this is consistent with internal capital market theory. Thank you.
Thank you very much, Giovanna. David, maybe a brief reply before going into
absolutely.
discussion.
Thank you very much for that discussion. That was really helpful. Much appreciate the comments. Just make a sort of a couple of things in reply to some of them. So, yes, you made a very good point. Why did they move the syndicated lending to the NOFB? So as we point out in the paper, and as you correctly read, they do have the syndicated lending was something where they had some discretion over where to put it. In practice, they did all put it in the NOFB. When we kind of spoke to supervisors and so on about why this was, the reason they indicated was, I think, probably the second one on your list. So basically, syndicated lending as an activity for a bank has a lot of synergies with other activities, such as underwriting securities and some of the other activities that did have to be in NOFB. It seems that this kind of encouraged the banks to move their syndicated lending into that subsidiary so they could do it all from one place. I think we definitely need to add something on that in the paper, because currently we don't comment on that at all, and I agree it's kind of a bit of a gap. On some of your last comments, where you're more making suggestions for future work, I think I can maybe just say a couple of things which I think we can say a couple of things about them based on what we've done already. So one of them is that you pointed out that these separate subsidiaries within the same group, they can kind of, one can support the other whilst not relying on the other. In the case of the ring fence regulation, it's quite sort of unidirectional. So essentially, the requirements mean that the retail bank cannot support the investment bank, but actually the investment bank can support the retail bank. So interestingly, there's kind of a sort of asymmetry on that side. And one other thing I thought I'd mention, given it was kind of quite related to some of your comments at the end about the overall default probabilities. One thing we did think as a potential alternative explanation for our results was that perhaps due to the asymmetric support I just described, it could have been the case that funding costs go up for the investment bank and down for the retail bank, not because of our deposit channel, but because of wholesale investors' expectations of which is more likely to default. So the investment bank arguably becomes more risky and the retail bank safer, and that could have potentially explained our results through wholesale funding costs. We have tested for that and found that our results held despite that other alternative explanation. So thank you again for the comments.
Thank you very much. Questions from the floor? Comments? Okay, I see David here. And then Rafa. Okay, let's start with Rafa.
Okay, now in your presentation, you would like to call the direct effects of ring fencing, i.e. more deposit funding available for mortgage lending. But perhaps there is an indirect effect to the extent that mortgage lending is safer, and therefore this might reduce risk-weighted assets and free up some capital that will be available for lending. So I don't know if this is a relevant element of the causality that goes from the separation to the increase in mortgage lending. I have a second question. You said at the very end of your presentation that small banks increase risky lending. How do you measure risk-taking?
Okay, let's take the next question, because we are sort of bad in terms of timing.
Thank you very much. Two quick questions. One is, do you find any effects on the deposit market? So did the more affected banks change the quantities or the prices? Maybe that's also a direct effect. Maybe you argumented about that. And another one that's related, what happens to other retail-related credit that could be high risk? Like, consumer lending, so is this only mortgages because it's safer? And then there's some equilibrium there that I don't know, or did it happen across the board? Also, there was more lending to more risky retail lending. Thank you.
Okay, so please, unless there is someone else, please.
Okay, thank you. So yes, I'll go through those possibly in a slightly different order. So in terms of how we measure risk-taking in the mortgage market, so we did that using the loan-to-value ratio. So basically, we define high loan-to-value ratios as the riskier mortgages. In relation to one of the other questions about risk-taking, so we don't have similar kind of granular data for other parts of the consumer market, so we haven't been able to do such granular tests. One thing we have done, though, is we did test whether these directly affected banks, whether they increase the riskiness of their mortgage lending in using this measure of LTV, and we found no effects there. On the other couple of questions, so in terms of freeing up capital, so interestingly, it turns out that these ring-fence banks actually have higher average risk weights. So the non-ring-fence bank, I think they include a lot of things like repo and so on, which has low risk weights. So actually, it wasn't very clear which direction the kind of capital release would go, at least from a regulatory perspective. We have done some tests along those lines, nonetheless, to dig into it a bit, and we didn't, our results were robust to those kind of considerations. And finally, on the deposit market, we have had a look at deposit pricing. We didn't find any clear patterns there. But I agree that that would be a natural part of the story. Thank you.
Thank you very much. Thank you both, David and Giovanna. And let's move to the last paper in the session and also in the conference, with a bit of delay, by hopefully not ending with more than 10 minutes from schedule. Okay, so it's a pleasure to have Juan Londono from the Federal Reserve Board presenting financial stability, governance, and central bank communications.
Great. Thanks so much, Javier, and thanks to the organizers and to all of you who stayed all the way till the end of the conference. I know how difficult it is. This is a joint work with Stein Claessens at the BIS and Ricardo Correa, also at the board, so the usual disclaimer applies, that these are our views. I wanted to tell you before getting started the kind of questions that we had in mind. Ricardo and I worked on a paper about sentiment in financial stability reports, and we left a few questions unanswered, I think. One of them was that we found that the sentiment in these reports was actually a very good predictor of crisis. So that meant that central banks were crying wolf, and the wolf was actually coming. So in a way that was very coherent in terms of communication, but it might also be perceived as that the central bank was not effective at, for example, using other tools to prevent the arrival of the wolf. And the other interesting thing that happened right at the end was when we've collected all the reports, we received the report of the Bank of England after Brexit, and it was a surprisingly positive report. So that was another unanswered question, like, is this perhaps a communication strategy? So let me try to, in this paper, we learn a little bit about these questions. So to summarize what we do, we're going to investigate how differences in financial stability frameworks across central banks, we'll explain their communication strategy, how they use other policy instruments such as macroprudential tools, and how these combined strategies are effective at sort of preventing the deterioration of the financial cycle. I'm going to start by showing you the conceptual framework that we propose. And this framework, it's very simple, but it teaches us this interaction between characteristics in terms of governance frameworks and the communication strategies by these central banks. And we're going to empirically test the hypothesis from this framework. And I think the main finding in the paper is that stability governance frameworks, they actually shape the communication strategies by the central banks, and they also have effects on how effective these communication strategies are at alleviating the deterioration of financial cycle conditions. So in a way, this was telling us that the results in the previous paper that crying wolf and the wolf would actually arrive does not apply to all banks. There are some central banks that are able to cry wolf, and when they cry wolf too loud, they're actually able to prevent the arrival of the wolf. And I think the main policy implication of this was that financial stability communication is a powerful tool for central banks that participate in interagency financial stability committees. And as usual, I think it's interesting to place the paper in the literature, but I'm not going to spend too much time on this. We're going to bridge a gap between, obviously, governance framework literature and financial stability communication literature. Several papers on governance frameworks, mostly on developing databases for this. I think most of the literature on central bank communication has focused on monetary policy, and when they try to explain heterogeneity, which is the goal of this paper, they center the attention on transparency. There is literature on financial stability communication, but bear in mind that financial stability reports have been published only recently, so that would explain that this literature is still developing, and that includes my paper with Ricardo and some papers that, earlier papers that explore sort of descriptive characteristics. And I think the contribution here is basically what I told you, that we're going to see the effect of this heterogeneity in the communication strategies and the effectiveness of these strategies. Let's move on to the conceptual framework. So this is a very simple framework. It has 3 periods. In the first period is where central banks collect information. So they're going to receive both public information and private information, and they're going to form expectation about the evolution of financial cycle conditions. And in period 2, the central bank is going to act based on the information. So we're going to center the attention, of course, on financial stability reports, so communication about financial stability, but in that period, the central bank can also implement macroprudential tools or change the monetary policy rate. So it's going to take action in general. So in terms of communication strategies, the central bank, whatever the central bank is going to write on these reports about the current conditions, is not necessarily going to be exactly what the central bank observed. And one of the hypotheses here could be that the central bank is basically not revealing the private information, because, for example, the private information might signal a deterioration in the health of the financial system. So it's better not to reveal that information because you're actually going to cry wolf, and the wolf is actually going to come because you said the wolf is going to come. And the other strategy about the future conditions could be that the central bank is seeing characteristics that is telling the central bank that conditions are deteriorating a lot, but the central bank knows that they have the tools to prevent the arrival of the wolf, and therefore they're going to convey a message about the future that is a little bit more positive than what they observe. So this is similar to what we thought about the report by the Bank of England, right? It's a message of relative calm that reflects the resilience of the system rather than reflecting the risks that they are observing. And in the third period, it's very simple. Things are going to evolve based on where they started, the initial conditions, the tools, the policy tools implemented by the central banks, the actions, and then it could also be shocks, right? So effectiveness of communication is going to be simply when the central bank is able to reduce the probability of a crisis. We only have two things can happen, a crisis or a normal episode. So in summary, there are basically 2 hypotheses that you can put like in terms of an equation. One is about the effectiveness of communication, and in this hypothesis, the left-hand side variable is going to be the evolution of the financial cycle, and the right-hand side is going to be an interaction between the sentiment in this report, so communication strategies, and governance characteristics, right, to tell us about the heterogeneity. And then the second hypothesis is about communication strategies. So we flip things, and the left-hand side equation is the sentiment in financial stability reports, so communication, what the central banks write in these reports, and the right-hand side is going to be the current conditions that the central bank is observing and governance framework, right? So whatever I observe, but based on my characteristics, I might decide to send a message of calm. So let me tell you, we test this hypothesis using three databases. One is about governance characteristics, which is a project that has been used at the board, and Nelly Liang and Rochelle and Ricardo Correa also started creating this database. The other one is about financial stability communication, and this is basically going to be the text in all these financial stability reports by 24 countries between 2005 and 2019. And the last one is obviously going to be whatever we can find about financial stability conditions. So I'm going to tell you one by one. In terms of governance characteristics, we're going to center the attention on three characteristics. One is whether the central bank participates in a financial stability interagency committee, whether that committee has powers, and in this case it's mostly powers to implement macroprudential tools. And the other characteristic is whether the central bank has an oversight role for the financial institutions in the country. As you can see, we have a little bit of everything. Central banks that have all characteristics at the same time. Some central banks only have some characteristics, and Poland doesn't have any characteristic. These characteristics are time varying, so there were changes in our sample, very few, but this is a snapshot of 2017. The second one is what I told you, the financial stability reports, and we're going to calculate with each report for each country a sentiment index that is going to be super simple. It's going to be the proportion of negative to positive words. And then how do we know if a word is positive or negative? Then we're going to use the dictionary that we created for the previous paper, which we did manually, basically, by reading all these reports and implementing a few. So it's a dictionary that is available online. So the intuition is very simple. Whenever the sentiment index increases, there is a deterioration in sentiment because it's a proportion of negative to positive. And the final one is about financial cycle characteristics. Today I'm only going to have time to show you everything that has to do basically with credit to GDP gap, but we also have other measures of financial cycles such as the debt service ratio and the total credit to the private non-financial sectors. We're also going to define sort of a crisis in our sample, but these are not global financial crisis and COVID. We don't have COVID, but big crisis, but turning points in credit to GDP gap. So these are going to be local maximum in the gap. You can think of them as small crises or changes in the dynamics of the credit to GDP. We're also going to calculate a sentiment index based on news reports. So that's basically whatever is publicly available in terms of financial cycle characteristics. So remember that the first hypothesis was about effectiveness of communication. Left-hand side variable is going to be a measure of the financial cycle. Right-hand side, we're going to linearize this interaction between governance characteristics and the sentiment in this report. So there's going to be a dummy that takes the value of 1 whenever the central bank has a particular characteristic. It's in a committee with power, or it has an oversight role. But then we're also going to have a setting that is going to be a probit setting in which the left-hand side variable is this C dummy that takes the value of 1 if there is a turning point, these local maximums in credit to GDP. So this is a probit setting that is going to tell us the effect of communication at predicting crisis. So this is going to be the really cry-wolf framework. So let's start with the first one, which is the panel linear regression. Left-hand side in this case is the credit to GDP gap in the future. Remember, effectiveness is about what can we do in alleviating the deterioration of the cycle in the future. In this case, it's 4 quarters from today. And then I think what's interesting here is this beta 2, which is the interaction between the dummy for governance characteristics and the financial stability report. So we get a beta 2 that is negative and significant, and the way you could interpret this intuitively would be that in this case, credit to GDP is smaller when the sentiment deteriorates in countries with a financial stability committee or with an oversight role. So it's a relative effect. This is going to be the sole driver of heterogeneous effects of communication. So they have a relatively calming effect on the evolution of credit to GDP. And when we look at the sort of the cry-wolf setting, which is the probit setting in which the left-hand side is a dummy that takes a value of 1 when there is a turning point, here you cannot do the linear regression, you cannot do the interaction, but what we do is very simple. We split the sample into 2. So in each case, whether you have a committee or not, whether your committee has powers or not, or whether you have a supervisory role or not. And I think the interesting results here are actually for all the columns that have a no. So these are the central banks that do not have these characteristics, and as you can see, in all these cases, the coefficient is positive and significant. The way to interpret it is that when sentiment deteriorates, there is an increase in this FSS index, the probability of a crisis is actually higher. So this is exactly central banks that cry wolf, and the wolf actually comes. But see, for example, what happens when you participate in a committee that has powers to implement macroprudential tools, which is the third column, right? And then the coefficient flips, basically. It becomes negative and significant. And this is telling us that when sentiment deteriorates in the central banks that participate in a committee with power, the probability of a crisis is actually smaller. So these are the central banks that are crying wolf, and the wolf is not coming, right? They're sort of preventing the arrival of the wolf. So this only holds for committee with powers, and we're going to explore this a little bit in the future when we talk about communication strategies. In the paper, we have several robustness tests that I think some of them are very obvious. So we use other characteristics of the financial cycle, debt service ratio, total credit growth. We also look at sort of time fixed effects that are like using crisis in the sample to control for this crisis, and it also doesn't seem to affect. And we also think about other characteristics that could explain this heterogeneity in the effectiveness of communication, and they don't seem to drive our results. So whenever we include transparency, whether the English is one of the native languages, etc., we do not find that this affects our result. We're currently working on a few additional tests, for example, removing one country at a time, removing countries that change their governance frameworks right after crisis, because there might be some sort of endogeneity there. And the results are not driven by any of these things. So we now know that some central banks seem to be more effective at alleviating the deterioration of financial cycle conditions. Now the question is why? What are they writing in these reports that is making their communication strategy more or less effective? So this is the second hypothesis of the conceptual framework. So in this case, the left-hand side variable is whatever we're writing in this report, the sentiment in financial stability report. And then the right-hand side variable, what we did was start plugging variables that characterize the financial cycle. And in this case, I'm only going to summarize the result for when this index that we calculated is in news. So we calculated sentiment related to financial stability in news for each country. So this would be a summary of whatever is publicly available. So in this case, if you look at beta 1, you see a coefficient that is positive and significant. So this is good news in the sense that whatever central banks are writing in their financial stability report is consistent with whatever they're observing in the news. It would be really it would be a validation exercise if we get a negative coefficient in this case. So that's good news. They're correlated. But this beta 2, which is the coefficient associated with the interaction between the dummy for the governance characteristics and the sentiment in the news, in this case, is again negative and significant. So in this case, it means that although they're both correlated, the sentiment that the banks wrote in the report and the sentiment in the news are correlated, central banks that participate in a committee send, in relative terms, a calmer message. So this relates a lot to this Bank of England report that was highlighting the resilience of the system instead of sort of emphasizing the risks of the system. But this only applies to central banks that have these governance characteristics. And then, why would a central bank send a calmer message? So one of the hypotheses that we tried several, of course, was that these central banks that had the ability to implement macroprudential tools were actually being coherent, and they were implementing these tools, and therefore they were crying wolf, but they were sending a relatively calmer message in the sense that they were saying, the system is resilient and we have the tools, so we're going to prevent the arrival of the wolf. So let's see if this hypothesis holds. So in this case, we're going to try a little bit of coherence. When the sentiment deteriorates in a financial stability report, are these central banks going to apply more macroprudential tools? So left-hand side variable is going to be the implementation of macroprudential tools in the future. And what we find is that indeed they do. If you look at the beta 2 in this case, which is again interaction between the dummy and the sentiment in financial stability reports, it's positive and significant. So in this case, it means they're being coherent. If you participate in a committee and this committee has the ability to implement the tools, you are indeed going to implement more macroprudential tools, and this could explain why you need to send a calmer message than the other banks. And remember, this might also explain why you're being more effective at alleviating the deterioration of the cycle. We also do a lot of robustness tests here. We try the interaction with the monetary policy, communication and monetary policy rate. Causality here is a bit more complicated because these are two different mandates, but they also seem to be coherent except when you're approaching a crisis, in which case, instead of sort of increasing the monetary policy rate to prevent the deterioration of the conditions, it might be too late, so you do the opposite. You reduce the monetary policy rate. Another thing that we find, we thought it was very interesting, is that when you repeat the probit setting for the prediction of crisis, you find that even if you control for policy action, communication by itself is a powerful tool, and the central banks that participate in a committee, even after implementing the macroprudential tools, they're able to reduce the probability of a crisis. So, because it's late, I think I'm ready to conclude. I think the main finding is that communication by central banks that participate in interagency financial stability committees is relatively more effective at alleviating the deterioration of these financial cycle conditions, and more importantly, at preventing this financial crisis, or the cry wolf hypothesis. The strategy of these banks seems to be to transmit a relatively calmer message. And the idea behind this calmer message is because, well, one of the hypotheses that we test is because they have the ability to implement tools that will prevent the arrival of the wolf. So looking forward to Oren's discussion.
Thank you very much, Juan, also for saving 4 minutes in the total agenda. Oren is the discussion, Oren Sussman from Oxford.
So thank you very much. Delighted to be here. Rafa, I think I've never seen so many economists so happy to see one another after a year and a half. So in this case, you not only educated us, you have been a kind of Santa Claus to us. So thank you very much. I have to start with an apology. I think I by mistake, I looked at the previous version of the paper, so that my notation is slightly different. So I apologize. I don't think that I'm missing too much. Let me start by trying to describe the conceptual framework of the paper in a slightly different way, using the standard structure, conduct, and performance framework of industrial organization. So the structure is that there are 4 categories or 4 classes of central banks: those who are members of committees, those who are members of committees with power, those with that have mandate for regulation, and those who directly regulate. So this is the structure. Then the conduct is a policy function that goes from the structure, some state variable, and the information that the central bank has, both private information and public information, to policy, and the policy is both communication and the instrument, and then the performance is how the policy affects the state variable in the next period. And the implicit question is whether the policy function is maximizing the objective. So this is obviously a hugely complicated conceptual framework. And the first step that the authors take is to obviously simplify it. The communication is limited to a single index, which is basically an index of pessimism. I went back to your dictionary. I was interested to see that you have almost 400 words in your dictionary, of which only 100 are positive and all the rest are negative. So that tells you something about central banks being quite gloomy entities. It's also a message space which is obvious, which is hugely restricted. I mean, if you think about some of the messages that central bankers have been sending, like I have this famous citation by Alan Greenspan to a journalist. He said, if I've made myself clear, you must have misunderstood me. So hugely more complicated messages. And I will get back to this Greenspan view of the world. Now, the main interest can be formulated as some sort of a cross derivative, which is what is the effectiveness of the instrument, or what is the effect of the communication on the effectiveness of the instrument, given the structure, the state, and the information. So I'm emphasizing again that this is hugely complicated. If you want to think about it a bit more intuitively, think about Draghi's statement that we shall do whatever it takes within our mandate, and then adding, and believe me, it will be enough. So what would be the effect of the policy if he didn't say, believe me, that this would be enough? Pardon? Yeah, it's the 2015. A good question. I have no answer. So that sounds like an introduction to a discussion of endogeneity, and I don't want to bore you with another endogeneity analysis. Let me start with some of the very interesting correlations that I think that the authors document, and this is the first one, which I really found fascinating. It's the evolution of the sentiment of the bank next to the evolution of the sentiment of the news. And what we see here is I found it really surprising. First of all, you see that the central bank is more volatile, has a bigger amplitude than the news.
I think, Oren, you have to click for the next slide.
Oh, sorry. That the central bank, which is the red line, has a bigger amplitude in terms of pessimism and optimism than the news. We usually think that the news is hysterical and the central bank is a calming effect. At least according to this measurement, it's the opposite. Not only that it seems that the news is picking up the turning point before the central bank. And not only that, they tend to be less optimistic in the run-up to the crisis, and less pessimistic once the crisis takes place. I mean, I think that these are really interesting observations. I found them fascinating, and I think you should do more with these. So then you go on into an analysis which I found very interesting about the sentiment, the relationship between the sentiment of the central bank, the FSS, and the sentiment of the news. You find out that there's a high correlation, but you also have you are playing with the leads and the lags, and you show that the central banks are more affected by the news than the news is affected by the central bank, which I found very interesting. And then you summarize this finding with this cryptic sentence that it shows that the banks are strategic in the use of communication, which I think that is not. I mean, you have to be much more explicit about it. I mean, I think you have hinted, but about the economic interpretation. But I think that basically there are two interpretations to this. The first is the one that I think that you prefer. And this is that the central banks, particularly those who have powers, know that they are going to use tools, and therefore they can be more optimistic, and they convey that information. The other one is that the central banks are simply afraid to be seen as too pessimistic, and therefore accelerating the cycle. I have to say that many years ago I did some work for the Bank of Israel, and in one closed session or closed consultation, one of the economists of the research department said, if we carry on this policy, we risk a crisis in such and such circumstances. And immediately the discussion focused on how dare you use the word crisis in the Bank of Israel. And he said, oh, sorry, I used the wrong word. They said, no, but you used it. And any attempt to get it to the issue itself failed. So I've collected a little bit of evidence myself about the relationship between news and allocation of blame. as you know, I'm coming from a country which is now suffering from shortages. And YouGov, which is a pollster in the UK, have run a survey about who is to blame for the fuel shortages. You can guess the answer, but here it is. 47% say it's the media. So only 23% of the public thinks it's the fault of the government, which is 100% responsible for this mess. So if the central banks are afraid that if they'll be pessimistic, they will be blamed for it, they know what they are talking about. They're absolutely right. Anyway, you carry on with this analysis where you put, here I think you've changed the, I'm sorry, you changed the notation. So Fs is the state variable. Fs, you have a leg on the right-hand side and you have the sentiment. The first amazing thing is that once you add the leg, the autoregressive picks up everything. And the FSS variable, not conditional on the structure, on the D, has no predictive power, which again I found amazing. Once you move, you add the structure into the analysis, you find that yes, some central banks have or show a correlation between sentiment and outcome, but it is only those who don't have, who are not member to a committee, which I find again very interesting, even as a style. In fact, my interpretation would be towards the second of the previous hypothesis, namely, if you are not responsible, you are more free to say what you think about it. And similar results are in analysis that tries to pick up the turning point. So the question is whether we can have a sharper separation or sharper test between the two hypotheses that I illustrated. Here is my suggestion. Run the regressions that you do that have, I repeat, you have the Fs, which is the state variable, and the sentiment on the right-hand side. Do exactly the same regressions, but replacing the sentiment of the central bank with the sentiment of the market as captured by the news, and see to what extent that changes the R square. If the R square is almost the same, then that will be a strong evidence, in my view, that the main thing that drives the result is the reluctance of the central banks to be pessimistic and therefore be blamed for the crisis. I also I was reading your paper and all the time was thinking about these well-known figures that show the forecast of the Bank of England to its own policy instrument. So what you see is that in 2009, the Bank of England say, yes, sure enough, next year we are going to start increasing the interest rate, and that doesn't happen. And in 2010 they say, it will happen in 2011, and so on and so forth. Usually the Bank of England was right for the first year, which is also the period that you are looking when you do the leads and lags. The banks know what they are going to do a year ahead, but they know very little about what will happen next. I'm not sure that you can fit this figure into your analysis, but when I was reading your paper, I just thought, how can we talk about communication where there's such a strong evidence that the central banks were lagging or were failing like most of us. I'm not trying to be sarcastic about central banks that are hosting us so generously, but it is a fact of life that we knew very little. I'll stop here.
Thank you very much, Oren. Juan, you want to respond briefly?
Yes, no, these are all great comments. I think I especially like this. You're asking us to play a little bit more with the sentiment in news, which at first we thought it would be controversial, right? Because there is all this, the news are always panicking and how informative that would be. But I really like this testing heterogeneity with the new sentiment replacing. That would be great. I think in terms of why central banks cry wolf, another hypothesis that we had is that if you are a central bank that you do not have enough tools, either because you do not have the oversight or the ability to implement macroprudential tools, you might also need to cry wolf to warn the other agencies to act for you. Otherwise, you would be held accountable for not warning people. So that's another hypothesis that we discuss in the paper, and that could explain a little bit the communication strategy. Another interesting thing is that I think most of the things you've said about policymakers, they seem to apply very well to speeches. So we tried a very similar exercise with speeches instead of financial stability reports. Financial stability reports seem to have much more information than speeches. When we summarized the sentiment in speeches, it was basically a flat line. So they do not say anything. In terms of sentiment, they do not convey any sentiment.
Yeah, they follow the Greenspan policy. Yeah.
So I think what you're saying is completely true. Financial stability reports seem to be candid. It might also be sort of an endogenous thing that financial stability reports are new, central banks start learning about communication strategy, was more effective or not, and they'll end up converging to vague information. So it could well be that if we repeat this paper 20 years from now, there's just no information. But thanks so much for your comments.
Thank you, Juan. Responses or questions from the audience? Elu here. Oh well, okay, let's go that way. So David Marquez.
Okay. So I enjoyed the paper a lot, and my question goes in the direction of Oren, which is that based at least on my experience working in central banks, sometimes the financial stability report, they are even more cyclical than the financial markets themselves. And at the same time, if you perceive there is like a housing bubble, for instance, you put relatively negative words in a way to cover up yourself if the crisis arises. Look, I warn you. So for instance, if you read the financial stability report I'm thinking of two major central banks just before Lehman, they were relatively positive. And but the actual assessment is a very positive one. No? So whether you have, I guess, what I'm trying to tell you is that whether you thought of weighting the main message as opposed to the words, because on the word you might want it to cover yourself for possible risk as opposed to the main assessment.
Thank you. Let's go to the next, then we answer all together. So I saw Elu, if anyone else is interested, okay.
Yes. Thank you. I have this impression that central banks communicate on many fronts, and so the question is there a danger of these messages getting mixed up? So, I mean, obviously, there is more than financial stability to communicate. Clearly, the financial stability reports are supposed to be read only by people who are interested in financial stability, but of course journalists and others read everything. So you may interpret these words also in different contexts than the ones you're looking for, like monetary policy or like political or fiscal or whatever kind of things. So is there a danger of these messages being ambiguous, potentially even conflicting?
And Rafa.
I was surprised to see that you use the credit to GDP gap as the key outcome variable. And in this house, I think that Angel can attest to that. It is regarded as a terrible indicator for the countercyclical capital buffer. It's a slow-moving animal. It has a lot of inertia. So I would favor going to credit growth, or maybe credit growth minus GDP growth, as opposed to the gap, which I think is not particularly useful for. I mean, you were referring to turning points. I mean, I don't think that this is very good for picking turning points.
Thank you, Rafa. So, Juan, a couple of minutes for responses.
Yeah, David, I don't know if I fully understood your question, but main assessment, so we do some robustness tests using only the summaries in these financial study reports, which at first we thought maybe they do change the message between the tables and all the technical information and the main message, which might be seen more by the governors and the policymakers, and they seem to be pretty homogeneous, the message of the paper. So I think that's what you referred. So about mixed up messages, I think one thing we could do is to sort of interact, for example, monetary policy communication and financial stability communication. That's something we have not done. Something that is interesting is that unlike monetary policy communication, financial stability communication is not picked up by the press. So when we did a search about around the window when financial stability reports are published, they're not picked up by the press, at least directly mentioning them. They're long, they're hard to digest. So I think in this case it's not a causality relation in terms of the press will read the reports and reflect, or the board will read the news and reflect. It's a little bit of I would think about a correlation. But they might interact with other types of communication. So that's something we should definitely try. And Rafa, I think, yeah, that's a good comment. I showed you the results for the gap. The BIS seem to support those very well, but of course you guys, we have the other ones that they like them very much. We do have some with credit growth, but not the ratio that you're suggesting. So I'm definitely going to add that one. Thank you.
So I think you are starting a very interesting field that will get further. Very interesting data in the coming years, no? Since macro-proof has only started. So let me finish with two pieces of communication, not of the type that markets will value. First, I would like an applause to the ones who have participated in this last session. So thank you for the participation. And then, of course, because this is the end of the meeting, I would like to thank again the leaders of the organization, Rafael Repullo and Angel Estrada. But I will also take the opportunity, and I think this is a really big applause now, is also for those in charge of the details behind. And in particular, Jorge Galan and probably all the team behind, also behind the computers, behind the cameras and the sound and the helping in moving in this wonderful building despite the gloomy element of the central banks. Thank you. Thank you very much.